More Trump tariffs mean more volatility, and we should expect more headlines early this week. The story that rocked the marketplace on Friday, though, was exploding inflation expectations from the University of Michigan survey, which was likely due to the tariff talk in the first place. But despite these concerns, interest rates still closed below a key level on Friday. And I actually think that based on a couple of energy metrics, we can see a small downtick on CPI this Wednesday. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, we've got ourselves a green-bodied inverted hammer, where of course, in the upper wick, we know that sellers stepped up and they were able to push prices in the downward direction, but we've still closed a green-bodied bar, meaning that the closing price was, of course, over the opening print for the week. It's almost the identical bar as what we had last week. There's a little bit of a lower wick on this week's candle, but that would only reinforce more of the bullish data point, in my opinion, which is just that you can clearly see we opened on another gap down. Of course, the tariff headlines over the previous weekend caused another Monday gap down, and the sellers were once again unable to capitalize on any sell-side momentum here from the weekly perspective, opening underneath this candle's low, underneath this candle's low. No momentum to the downside on the weekly, trying to make a move into the range lows from back over here. So candle structure does strike me as being slightly more bullish with the green close towards maybe the midpoint of the weekly range here. If we consider the bar-to-bar count when it comes to location, we do technically have a lower high as well as a lower low. So maybe a bit more bearish from that bar-to-bar perspective, but again, the close of this week's bar being back inside of the previous weekly candle after gapping down underneath the previous week's range, it just doesn't strike me as being outright bearish. I mean, maybe you could make a leap of faith and call it neutral here, but if we just lean into the overall trend on the weekly time frame chart, we still have lows. We have higher lows. We had soft higher lows, firm higher lows, soft higher lows, firm higher lows here. This is easily an opportunity for the market to continue trying to build out a new set of firm higher lows on the weekly. And I would add into this, it's another weekly close above the threat of the right shoulder. Remember that a while back, really not that long ago actually, we were talking about, hey, if the weekly trend is going to reverse, maybe the head and shoulders pattern is what ultimately does it. But one more time, look at where we've closed. We've closed over the threat of that right shoulder after multiple gap downs, both last week and the week before. None of those gap downs really yielded much sell-side pressure here. Again, we'll acknowledge the upper wicks, and we're giving credit where credit is due. It's not like we're, in a raging bull market printing new all-time highs every day, but it's really not that bearish here on the weekly time frame chart from what I can see, just purely based on trend count and candle structure. We can come in here with the anchored VWAPs as well, and what we'll notice on the weekly is that we've closed yet again over the entire stack after gapping down underneath the top 2 anchored VWAPs. So if I ask myself the question, do we have stronger sellers stepping up on the weekly time frame chart, the answer is no here based on the VWAPs. If we come in with the Fibonacci's, what we'll find is almost the identical answer, right? This, of course, will not change. We've been over the 38.2 for a number of weeks now. This was the closest we got to a test of it, and there really has not been another attempt to get back down towards that level. So are we bearish from a Fibonacci perspective? Absolutely not. What about if we come in from here up to the all-time high? That's also another candle close over the Fibonacci 38.2 after gapping down to open the week underneath. Do we have stronger sellers on the weekly? The answer at this point continues to just be a resounding no. The last thing I'll say about the weekly, though, is that it is possible that instead of a head and shoulders, maybe this is a double top. Now, I don't want to speculate too much because, as we say here on the Trade Brigade channel, it's not a double top until it is. What do I mean by that? This is an equal high. It still has the possibility of forming a higher low. The only time in which case this double top is going to be validated is if we break down underneath the neckline. And in this case, the neckline of the double top that we've been identifying and talking about for probably too long now is down here at 580. If we break underneath 580, if we break underneath the neckline of the double top, then fine, we will have a lower low in the weekly trend count, and I will raise my hand and I'll say, hey, the market's changing tone on a higher time frame chart, but until that happens, It is speculative, very, very speculative to just go out on a limb and say, hey, there's a double top, we're rejecting the same price twice, it's got to mean the market's going to crash. Not even close to the proper way of interpreting how this would work. So with that, we'll drop it on down to the daily time frame chart. We'll evaluate this week's expected move, which is almost unchanged from the previous week's expected move. It's this gray box right here. If you're not familiar with that study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's up here at 610.50 on the nose. That's looking like a higher high relative to last week's high, but it's technically right at the previous all-time high. It's not really suggesting a breakout to blue sky territory. If we're contained by the lower bound, it's a move directly into the Monday low of last week. So right on par with that level is 591. I would say the weekly expected move is very neutral based on the information we have on the screen in front of us, which really brings me back to what I was saying on the weekly time frame chart, which is that it's not really fair to say that the bears have an edge, but the bulls definitely... It's been a little bit lackluster over the past week or so. The reason I would say that is the grind certainly continued in the upward direction, but we talked about this on Wednesday. We were coming from a gap down, and the base case was trying to say we had lows. We were looking for a potential higher low on the deep seek gap down, and we really didn't want to see much price acceptance underneath that. Of course, the gap down Monday changed that. We talked about how there were no stronger sellers all the way up into the high of Wednesday. So on Thursday and Friday, one thing to call out here is just that we do technically have a daily sequence of highs, lower highs, and we did pull back within the range of setting another new lower high. Now, I'll still lean into the idea, and we talked about this on Wednesday, that the next higher low on the daily time frame chart basically needs to be set right here, right now, at 599.65, 600, the round figure, if you'd like that. I just don't know how likely that's going to be with the potential tariff talk that's coming over the weekend, perhaps, and into early next week. Again, I'm flat the market, so I don't have any positions on. I don't have a stake in whether or not we open on a gap up or gap down for Monday. But there are a couple of things that happened on Friday that give me a little bit of concern about whether or not we hold here at 599.65. So we'll get to those concerns in a moment, but from a picture-perfect trend count point of view, you would need to see the market hold lows. This is now the higher low because of the way that we violated deep seek. However, there was a strong rally, right? The next higher low needs to be right here. Then, if that takes place, we would start to build out, in my opinion, a stair-stepping move inside of an upper balance range, right? This could be your upper balance range. You have a move higher here. Ideally, it's back to the top of the range, some pullback for another higher low. We compress, and eventually, over time, you knock on the door a certain amount of times, and someone will eventually open up. That would be the bullish case here, and that's still going to be the base case that I use as we head into the upcoming week's worth of trade. I would say major concerns would start to emerge if we opened on a gap down underneath 599.65, attempted to rally, and then found some sort of rejection in the downward direction back towards Monday's low of last week and the lower edge of the weekly expected move at 591. The reason that that would be concerning is because it sets up a lot of overhead supply here, where now all of a sudden the deep seek rebound buyers are underwater, the tariff rebound buyers are underwater, and if we actually set the lower high, that is the key there. Let me put an asterisk on the screen for that one. You need to see a gap down, gap fill reversal lower high under 600. That would be the key if bears are going to take this and potentially run away with it back down towards the CPI gap. Now, if we just zoom out and think about this in the context of what we were just describing on the weekly time frame chart, does this move to test the lower bound of the weekly expected move actually break the double top neckline, which, keep in mind, here's top number 1, here's top number 2. The neckline would be way down here, right? Is that even close to breaking the weekly double top? The answer is no. So in the grand scheme of things, I would totally understand that if in this box, and we've been dealing with this box for quite a while now, if in this box we want to maintain more of that neutral stance, totally understandable. Something else that we'll get into when we move into the sector component of today's analysis is we only saw financials and communications break to new all-time highs into the end of last week. We really don't have a majority of the sectors participating in clean uptrends at all-time highs. So is there a justification for the broad market to be producing brand new all-time highs? If that's the case, when it comes to the sectors, seems like a little bit of a stretch of the imagination. So some neutrality here, as we're not really seeing sectors trending cleanly, strikes me as being very, very reasonable. So main bottom line here on the daily time frame chart is that ideally we see an open over 599.65. If that's the case, then I will give this the opportunity to set a higher low. We'll maintain the bullish stance. We'll probably be looking to exploit risk reward ranges generally along these lines here, with risk in the bottom box and reward back up towards the all-time high. And again, this is not one singular trade. This is just generally speaking about trade location. It would be more advantageous to be a pullback long here off of 600 if we can open above and stay above on higher low pullbacks, right? Targeting the all-time high. If we open underneath, the threat becomes, okay, gap fill reversal and then potentially back down to the top of the CPI gap. And of course, Monday's low from last week. But, again, you got to take that with almost a grain of salt here, because if we've learned anything from the deep seek gap down, if we've learned anything from the tariff gap down, I mean, we just don't have stronger sellers who are willing to produce gap fill reversal, who are willing to keep prices, at least in terms of last week, underneath 595.85. It just didn't happen. So early in the week, it's all about 599.65. Been very clear about that, very vocal about that here on the daily chart for the last couple of minutes. Here is your Fibonacci's from low to high. You'll notice that the 38.2 is technically just underneath 599.65. So is it possible still that on the daily time frame chart, this is nothing more than just a simple bull flag that's trying to hold consolidation over the 38.2? It absolutely is possible, and I would still sort of think back to our weekly analysis we just conducted, where this set of lows is a weekly higher low. So still leaning into that thesis, and one more time, the base case here, or first thought process, is probably bullish first, unless there's a severe gap down underneath 600 early on in the week. With that, we'll drop it on down to the hourly time frame chart and see what else we can learn about the price action this week. So it's very classic, right? Here's your, there's the blueprint. Monday gap down, you buy it and you sell it on Friday. You got to de-risk into the weekend, which makes somewhat of sense, right? Anybody who's cognizant of headline risk through the weekend who wants to sort of back things off, sure, makes sense that these Fridays are the day to sort of dump positions there. Anyways, on the hourly time frame chart, has anything changed here from a trend perspective? The answer is yes, but remember, you need the next smallest time frame to drop into the opposing trend if you're going to find a higher low or a lower high in the case of a downtrend on the higher time frame chart. So I was just pounding the table for a potential higher low on the daily time frame at 599.65. To achieve that, we would need an hourly downtrend to get there. Do we have an hourly downtrend? The answer is yes. We set a high, we set a lower high. We had lows, we set lows, and we even set lower lows into the afternoon session there on Friday. Even if you don't want to take that approach of calling this the last higher low in the trend count from the hourly, you could use the Tuesday high of day. This area right here. Did that hold up for an hourly higher low above? The answer is no, we broke underneath. Therefore, we're actually in a very short-term hourly downtrend. So if this can hold here, if we can now see an hourly trend reversal back in the upward direction, to give you an idea of what that might look like, if we open above, if we see a look below, fail, back into Friday's range, higher low, what have I just drawn? Right? This is your left shoulder, this is your head, and this is your right shoulder. That's an inverted head and shoulders hourly reversal pattern that gives you the daily higher low. And from there, we look to navigate and trade back up towards the all-time high. That's how you find alignment from the hourly trend to the daily trend, which is also sort of playing nicely with the weekly trend. So this is top of mind on an open over 599.65. And, it could be an inverted head and shoulders. It could look like a double bottom, something along these lines, and your neckline becomes this level, 602, Tuesday's high. It could look like just a simple hourly hammer candle, something along these lines. We're generally looking for buyers to step up near this 599.65. Now, of course, the flip side scenario is just that if we open underneath, gap fill reversal and double top here, now the hourly downtrend persists and we're not holding the key level on the daily time frame chart, and thus the base case is in jeopardy. What becomes the target? You have to walk them down. We're talking about 595.85, talking about a Brigade bolt for a lower high here, 591, Monday's low of last week, and that's where larger concerns would emerge for the market. Again, does this by itself break the weekly double top neckline? No, but it certainly neutralizes the daily trend more so with the lack of the higher low happening over 599.65. So those are the reasons why I believe this level is absolutely crucial into the early stages of this upcoming week. We could throw a Fibonacci from the Monday low up to the Friday high. And you'll notice it's half back of the range, 50%. So half back's not usually one of the golden zones, of course. It would be better if we held up over the 38.2 for like bull flag consolidation like this. We're slightly underneath, but you might give this the benefit of the doubt and say, okay, if you're looking for that confirmation inverted head and shoulders, if you want the break of the double bottom neckline, it's a recapture of the Fibonacci 38.2. Right? And then we look for that upside 100% retracement back up towards the highs. Underneath the 50% mark, then yeah, again, maybe more concerns would emerge, and things are definitely concerning underneath the 61.8. The more hourly candles we close below the 61.8, the higher the likelihood that we would travel back down for the 100% retracement to the lows at 591, of course. Let's clear that up. Let's throw on the intraday anchored VWAPs. And what do we see here? We've closed inside of the cluster. We still have some of the cluster underneath us. This is primarily the major low from back over here, but the all-time high anchored VWAP is above. We have this DeepSeek anchored VWAP above. This is even above as well, or we closed right at it, the Monday anchored VWAP. So is it possible that this is the do or die level? Otherwise, things can tend to get a little bit nastier? Absolutely. And once again, we're sort of open-minded to both things taking place, especially when we consider this data point right here. Again, base case leans bullish, but buckle your seatbelts if you're a bull, because this, unfortunately, is something we have to talk about. There was a huge character change out of the market internals on Friday. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner, and it all stems from the tick. It really all stems from the tick. Let's zoom in on this. Let's even go full screen. How about that? It's very rare that we do this, but what happened at 10 o'clock on the University of Michigan sentiment survey for inflation expectations? Huge negative tick. Instantly, I mean, you can see, right? The tick usually doesn't gap intraday. We're looking at a 15-minute time frame chart. This is not a daily time frame chart. We closed the previous 15-minute bar up here, and then we open the next 15-minute bar down here. You can even see this on a 1-minute time frame chart. Let's get crazy, right? Let's go back to the 10 o'clock time frame. This is the gap that I'm referring to out of the tick. Okay, this is an intraday gap as soon as the news hits the wire. Why is this important? Why are we talking about the tick in such detail today? Because if we go back to the 15-minute time frame chart, what I want to point out is the time spent through the session at and below negative 500. We have not seen this through any of the other liquidation breaks that took place earlier on in the week, right? Any other time that we opened, right? Here's Monday's open on the tariff news. Oh my God, the world's ending. Open at, what's the open down here? We're dealing with negative 13, negative 1400. Terrible open out of the tick. Instantly rebounds back up to pretty decent, buy-side reads. On Friday, when those inflation expectations hit, the tick stayed down here for a majority, you can see a long while. Not until noon did we start getting a first 15-minute bar to close back over the zero line. So I'm not calling for Armageddon. I'm not calling for, oh my goodness, the market's going to crash. Matt was talking about the tick. It's not really, bullish anymore. That's not what I'm saying. But what I am saying is, unlike what we talked about on Wednesday, where all of the other market internals evidence was suggestive of, hey, stronger sellers aren't really here, stronger sellers absolutely stepped up on that Friday session. And this goes way back to my point, which, goes all the way back to DeepSeek. I think it was maybe it was last Saturday's video where we did the deep dive on internals as well. But how can you use this to your advantage intraday? As soon as this news came out and the market went lower, right? This is the first impulse reaction at the 10 o'clock time frame. Do you want to be buying this as like, okay, it's just a dead cat bounce, the market's going to rally back in the upward direction? If you see the ticks acting like that, the answer is absolutely not. No, you want to be shorting any sort of bear flag that you can find intraday. So this move to me makes total sense. The fact that we saw continuation in the downward direction, there was a clear change in tone out of the ticks. If you were watching that on Friday, it was very, very clear. So although we didn't technically have big negative breaths getting underneath negative 300 million, although we weren't in trend lower zone, the index score was very weak, as you can see by the special flag over here underneath negative 20. I would say, even, regardless of this and this metric there, we definitely had a change in tone there. And hopefully through this illustration, you can see that, which, bringing it all the way back to, okay, what's the actionable takeaway for early next week? You have to see the tick. You have to see intraday. You have to see this, right? It's a real-time thing. We can look at it in hindsight, but in real time, you have to be able to look at your ticks and say, okay, are we staying over the zero mark as the market's above? If so, that's probably more bullish. Is the index score bullish? Our volume flow is bullish? Great. We're okay. We're holding the daily high or low. If we open underneath and the internals are screaming bullish, if we have index score green, positive volume flows, if we have ticks that are over the zero line, yeah, you should probably look for the fade of the gap and a move over the 600 figure. But if you open underneath, and if you see market internals like they were on Friday, do you want to be a hero trying to play the, quote, blueprint of what's happened the last few Monday opens, looking for a huge move back to the upside to end the week? Probably not. Probably not. So market internals, absolutely crucial. This is the key to trading the Trump volatility. We've been talking about it for a couple of weeks now. This should keep you on the right side of the trade. Okay, that is what we have out of internals. Let's finish up the S&P in particular with our market profile. Another confirming sell-side activity. If you're not familiar with market profile, by the way, check out the video tutorial in the top right-hand corner. The confirming indication here is that value and the point of control also migrated lower with price into Friday's close. We had opened, this is the white arrow up there, it's probably hard to see on your screen, we opened right at the previous day's high. And we saw a little bit of a pop to the upside, which promptly faded, of course, right? So in theory, if buyers were going to step up inside the prior day's range, if we were going to see buyers defend the single prints, remember these single prints from the Wednesday session, right? This stuff doesn't just evaporate once we're done talking about it. It's you carry it forward in the narrative. The fact that we could not stay in the upper distribution of Wednesday, right, this area right here, is an and value is overlapping to down, point of control is underneath that upper distribution. Again, not, oh my goodness, market's going to crash and go to zero, but at least as of Friday's session, we have undoubtedly seen a change in tone from the marketplace, and I think it would be ignorant to ignore these indications. So, open-minded to some potential downside here with the change in tone. The base case is still that we want the longs on an open over the level if market internals can suggest we have buyers stepping up at the exchange level. This is base case situation number one. The hourly trend reversal sets a daily higher low. The part where we have to say, okay, things are being jeopardized here a little bit is a gap down on weak market internals that gives us a gap fill reversal testing 595.85. If we drop below that, overhead supply should get heavy, and the CPI gap is in play as a possible downside target over time. That is your S&P analysis. Let's jump on over to the NASDAQ through the lens of the QQQ Cash ETF weekly time frame chart. What do we see? Let's go with that clean drawing set. Here we go. On the weekly time frame chart, we have ourselves, in terms of candle structure and location, very similar to the S&P 500, a green inverted hammer with a little bit of a lower wick, very similar to the previous weekly bar. We've closed inside of the previous weekly range. We technically have a higher low and a higher high. If you want to split hairs with me, that is a higher high. For all intents and purposes, it's mostly an inside range where we didn't really break out of the previous range by any substantial margin. We have closed still over, and this is all, I don't even know why I said closed, all of the price action over the past couple of weeks has still remained above the previous all-time high. So in the grand scheme of things, is it really fair to get bared up on the QQQ thinking about, oh my goodness, it's going to be a market crash? If we're over 503.25, I'll maintain the stance on the higher time frame charts. It's absolutely not worth getting aggressively bearish here. Now, one thing that we can start talking about is that the NASDAQ now has been in like an 11 or 12 week balance range. Let's count it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 weeks of balance, if you just consider this the balance range right here. So the reason I bring this up is because we all know that when you're trading the market, and generally auction theory would tell us this, right? Range compression then leads to range expansion. So a classic doubling of the range here, it could be up, it could be down. We're not making a directional call here on the weekly time frame chart, although I would tend to think higher has the higher odds because we're over this level. The trend is up, but typically a range double is what you're looking for as a target. So this is just a very brief eyeball test here on the QQQ weekly. We're talking about 570 on the upside, and if we double to the downside, we're really probably dealing with something more along the lines of 465, give or take. So that is something to carry forward, right? The volatility in terms of the range, let me classify, right? The range volatility is annoying and it's back and forth, but when we exit the range, that's when you're probably going to get a quick and snappy move, or we would hope for a quick and snappy move to give us this expansion of range after a formidable time frame of consolidation that we've been dealing with. I mean, geez, 11 weeks. 11 weeks, a fifth of a year has already gone by in terms of spending it in that box on a rolling period. So that is what we've got out of the QQQ weekly. I think we can throw on our anchored view apps quickly. We're above the entirety of the stack after opening underneath, so bullish just like we were on the S&P 500. Coming in from the low to the high, of course, we're over the 38.2. We can come in from the election low to the high, over the 38.2 with another weekly close there. Let's go ahead and move it on down to the hourly time or daily time frame chart first for the NASDAQ. Then we'll jump to the hourly. You can see something very similar here on the NASDAQ daily versus the S&P 500, where we have an expected move that's fairly muted. It's inside of the previous week's expected move. We have 534.24 on the upper bound, an equal high for all intents and purposes, not a breakout of the balance range. Lower bound is at 511.67, kind of an equal low on par with what we've been dealing with the past couple of gap downs. Now, something we talked about on Wednesday was the fact that on the Monday session of this week, relative to the DeepSeek gap down, we actually set a higher low. And this is why we saw on the bar-to-bar count from the weekly perspective a higher low, of course. So it is interesting to me that with a number of catalysts, and this is another thing that makes the analysis here a little interesting with the change in tone on Friday. However, if we think about like max fear in the market, max pain in the market, oh my goodness, the world's coming to an end, it's those catalyst moments. So I find it very interesting that, you've given the market every reason in the world to, see a move in the downward direction or break down generally from this balance range, right? Chinese AI as a potential threat to American companies, that's a pretty big deal, right? If you're going to bankrupt NVIDIA or, basically flatline the need for hardware going forward, that's a big deal. Market rallied, right? Tariff news, that's a pretty big deal. Trade wars, inflation, making, geopolitical risk, headlines, enemies perhaps, that's a pretty big deal. And yet the market still was unable to take out Chinese AI low. So you've given the market a number of opportunities to potentially break down, and nothing fruitful has really come from it. So I don't think it's worth being an aggressive bear, and really on the NASDAQ, more so than the S&P. The S&P seems like it has the opportunity to trend a little bit sooner than the NASDAQ here, but the NASDAQ's really just been stuck in a box. So no big bold calls here. I would say that 518 is your key level. It would be great if we could hold a higher low above that. Maybe we have higher lows happening here, maybe higher lows off of 518. That keeps us over a majority of the DeepSeek overhead supply. It keeps all the tariff traders who bought the dip in play as well, noting that that was the Monday low over here. So 518 could be it, but really, you can see this as clear as day on the hourly time frame chart as well. I mean, the market's done nothing over the last little bit in this range. We're in the midpoint of the range. You guys know what we say in the midpoint. Don't exchange in the range. Don't enter in the center. Don't fiddle in the middle. It's a tough place to be as a active trader with not much of an edge near a key level. So if we pull back to 518, maybe there's some scalp longs off of it. Would I say that we're going to the top of the range? I think it's a bold call to assume that we'd move from the midpoint to the top point. There's probably a 50-50 shot that you could also test the bottom end of the range. All it takes is a couple of headlines, a couple of tweets early on in the week, some more market volatility, and maybe you test the bottom at 510. So no bold market call here out of the NASDAQ. I think one of the things we have to be okay with as traders is just saying, hey, there's a lack of trend here. So to be aggressively, hey guys, pounding the table, it's got to be bullish, new all-time highs here tomorrow. Or the opposite, hey guys, pounding the table again. Bearish, it's going to zero, market's going to crash, it's all a fugazi, AI is nothing, it's, the world's going to crash and burn. I mean, those perspectives have not served anybody well inside of this balance range. So as a trader, as someone with the ability and the agility, right, this is the beauty of being a retail trader, is we can just wait and see. You can wait and see. We do not have a mandate to be fully invested at all times. I don't have a risk management desk breathing down my neck saying, hey, you're not putting on trades, you're not doing this, you're not doing that. Why is this happening? This, that. I don't have that, right? So, we can just wait. If we take out 510, maybe things get a little bit more bearish. If we take out 533.25, maybe things get a little bit more bullish, right? And to throw some spice into the mix, of course, you could have look above and fail, and you can have look below and fail, right? It wouldn't be a market without some spice in the mix, but we'll just take that one step at a time. And inside of this range, I don't think it's worth making any bold calls. If you really want to get granular with me, if you want to split hairs here, the only thing I think you might be able to pull off as of the close on Friday is saying something along the lines of, okay, we opened on a gap up over this 528. We saw a little bit of a test higher. Ideally, a higher low should have been produced over this level. So the fact that we've closed underneath now sets up an opportunity for this lower high. And now you have something like left, head, right shoulders. Maybe. So 528 could be seen as a notable area of resistance if you rally off of this sort of demand low in here, something along these lines. You might want to be cautious of 528, but once again, is that a bold call? No, I think in a neutral balance range, that's totally fitting. You treat every level as an individual independent level. So QQQ hourly complete. Let's quickly take a look at the intraday anchored view apps. Unlike the S&P, this is actually above the entirety of the stack here, which is notable. So if we can hold that 522, maybe that rotation does take place. I would still be even open-minded to this. taking place right here, recapture of that 522. So you drop underneath Friday's range, you get some closes and a higher low back inside of Friday's range. You could set up risk and reward for something along these lines right here. Concerns would increase towards the lower 50 percentile of the range if we got something that looks like this. Trade ideas looking like risk, and reward back down towards 510. We'll keep it simple there, although that was probably in-depth, probably doesn't classify or qualify as being saying, hey, we're keeping it simple. Here's the NASDAQ market internals. Really don't have big bearish outflows on that Friday session. We did move into trend lower zone, pretty high degrees of correlation there into the afternoon session on Friday. As we take a look at the market, or I should say the tick, specifically for the NASDAQ, not as bad, not as jumpy either. If we just take this down to that 1 minute time frame chart to explore what was happening with the 10 o'clock session. So no gap, instead just an open down here. You did spend some time underneath 500, right, for a while, but notice that this neutralized to zero and spent some time hanging out near zero again much more quickly than the S&P 500. I should just say the NYSE internals, right? So that is your NASDAQ market internals. Let's take a look at the NASDAQ through the lens of market profile, and it's just confirming the same thing. So value area point of control lower on Friday. You could call it look above and fail from this perspective, right, where we looked over the highs of all this stuff and then failed with value back down underneath the Wednesday high. It's not really a clean 2-day high, but it's close. You could also make note of the double distribution from Wednesday and say that the point of control is underneath as well here in the NASDAQ. Let's jump on over to the Rusty Russell. I'm just going to preset that to the Russell internals. We'll go over here. We'll take a look at the IWM cash. Weekly time frame chart kicks us off. What do we see? Levels, clean drawing set, please. Here we go. Candle structure and location. Just like all of the other indices so far today, S&P and NASDAQ, we do have, one of these things is like the others. We have a green inverted hammer. So all the same sentiment applies. The concern here is just the continued rejection, if you will, of the weekly level, right? This is as clear as day. It does not get any more obvious than the 227 level, and we've closed underneath it once again. So is it possible that you could say we have left, head, right shoulder? It's possible. We're getting close. Maybe we would start to lean into a little bit of a neckline that's a trend line like this. I would probably want to see some sort of rotation towards the lowest low before I would get overly bearish on the small caps here. But the upper wick is concerning, right? It's absolutely something worth paying attention to. It's worth continuing to talk about. Let's go out to a multi-year chart. And what I wanted to bring up was actually something very similar, right? Where you can see this long-standing consolidation, look above and fail, lower high in the range before things get painful. So what I'm talking about, and I don't want to be an alarmist here, but if this is your look above and fail, these were more so equal lows that took place in here, but this could be the start of a lower high. And again, we're going to keep very close eyes on that head and shoulders pattern here from a weekly perspective. I don't want to be prematurely alarmist and bearish and, oh my God, the market's going to crash, but it's something worth talking about here. Small caps have not really been playing nicely with the narrative of things are fine and dandy with the broad market as a whole. And I mean, this is the Russell 2000, not the S&P 500 or even the NASDAQ 100, right? 2000. The broadest measure of the market we typically look at is the IWM here. We'll save the Wilshire 6000 for another time, but you get the idea. That's a slight concern. When we're thinking about the trend count, we do not have equal highs for a double top. We already have the lower high. That's the whole point of the right shoulder, right? So these things are top of mind for small caps. We can quickly throw on the anchored VWAPs. We are in between the two key clusters, still rejecting the highs, but still supporting the lows. So again, I think it's premature to say it's going to crash and burn and go to zero, but it is walking that line a little bit more finely than the S&P and the NASDAQ. Let's go on down to a daily time frame chart for the small caps here. And we can see this, right? So we opened on Thursday, on a gap up over 230, which was the very obvious level, right? Look at all these prior equal highs, suggesting that the auction did not end properly there. The open on Thursday above could not catch support for a gap fill reversal to stay above, never mind go to the scene of the crime, the origin of the Powell plunge. So, that's strike number one. Strike number two is on Friday, closing underneath 227. Notice that on Wednesday and Thursday, the lows of those bars, the lower wicks, were supportive of that level. Friday says, no thank you, we're back underneath. And, this is hashtag New Balance, not sponsored, although we've talked about the marathon sponsorship. If someone reaches out, more than receptive to throw up the New Balance logo right up here or something like that. We'll make it front and center for people. So the New Balance range has not broken down. And I would say, piggybacking off of what we said on the weekly time frame chart, if things are going to, emerge as being more concerning, I would probably just say, okay, underneath 223.75, I don't know, what more do you want to see? It's failed to gap up and over 230. It's failed to hold a close over 227 underneath the bottom of the New Balance range, and we're probably thinking about lows, break of the daily 200 SMA, and possibly triggering the weekly head and shoulders pattern. If you want to be an optimist here, you could say, it's just an overshoot. It's going to come back above. We're going to form some sort of ascending triangle here and then break out into the future. Although that's technically a possibility, everything is always a possibility and it's on the table in the market. I would say that probably to me, it seems like it has lower odds with the failure of Thursday and Friday. So I would assign lower probabilities to that. Here it is on the hourly time frame chart. You can see that on Thursday, we actually had much more of a severe intraday downtrend. So there's the gap up, failing to hold over the Wednesday highs. We end up moving lower, lower high here. So the hourly trend is already in force to the downside, rejecting this area here. Support acting as resistance into the afternoon on Friday. Let's take a look at the intraday anchored view apps for the small cap side. You can see we have a little cluster and we are primarily underneath the cluster. And again, the idea would just be another lower high or rejection of 227 keeps the bears in control here, looking for that rollover to the bottom end of the New Balance. Let's take a look at the Russell internals. We can see pretty decent volume outflows, very close to substantial on the Friday session, confirming our suspicions so far that the bears do have an edge near trend lower zone, but not in it. And the cumulative build, of course, is bearish as well. Let's flip on over to the market profile side of the Rusty Rut, and we'll see what's going on from this point of view. Value area on Friday, certainly breakaway to the downside, point of control breakaway to the downside underneath the Tuesday high, right? So notice that the value area high is on par with Tuesday's high from back over here. Technically, it classifies as being mechanical, and we have a poor low out of the session on the Friday as well, meaning that that's in need of repair. The auction did not end properly, and it's very reasonable, right? Look, almost, not quite, but very, very close. If you break the poor low, you also move into A period single prints from the post of the P-shaped profile back here. That's Tuesday as well. That would be thought of as thin structure, and you should target Tuesday's low. If this takes place, we would know that this should act as a headwind for the S&P 500. Okay, that is your Rusty Russell check. Let's take a look at these sectors, because this is where it gets fun, and the conflicting data points as we just remain stuck in this range sort of continue to emerge. So weekly performance of the S&P sectors, who was leading, who was losing, where was the weight? The semiconductors lead the pack here this week, up 3.83%. It's not technically an S&P sector, so the next three are the technology sector, over 3%, really strong performance there. We have real estate, we have financials. Financials have been the golden poster child for the S&P 500 over the last couple of weeks. We'll see that on the structural chart. The only sector closing red is the XLY, down 0.69%, 69 basis points. We have healthcare, the next laggard here, up 31 basis points, and then materials up 46 basis points. Generally speaking, this does look like risk-on posture as we're approaching the top end and the all-time highs in the market. However, the structural charts, they speak for themselves. Let's start with semiconductors. Is this breaking out? Is this trending? Is this doing anything interesting over the last couple of months, the last quarter and a half even? The answer is no. We're still stuck sideways in this range. So when I think to myself, why would I expect the S&P 500 to be in a clean daily uptrend, breaking to new record highs over and over and over again if semiconductors are going sideways in a box and have been doing so for the last couple of months? That's kind of an unreasonable expectation to have for the S&P 500. The neutrality, it makes sense. Now, I'm saying this as we've been in the range for a very long period of time, which means that sooner or later, we will break out of the balance range and we will have a directional indication for the S&P 500. So don't get too comfortable and don't just say like, okay, it's going to remain in a range forever, but it's worth, again, managing that expectation and tying back the performance of the sectors to the S&P 500. Is this a shock? The answer is no here out of semiconductors. If we look at the technology sector, are we shocked? Is it surprising that the S&P is more neutral in a range? The answer should once again be absolutely not. There's a strong recovery off of these lows. And, if we want to get granular with the technicals, that's fine. We could say something like, okay, the double bottom neckline from over here, we gapped underneath it once, market rallied. We didn't quite gap underneath it there, but we tested below, market rallied. We opened and gapped below, market rallied. So the sellers have had every opportunity to potentially break a key area of support, and none of those instances could we close the daily bar underneath. So does it make sense that the broad market's at least not bearish? Does it make sense that we're still having that bullish mindset and bullish base case from the weekly perspective? The daily higher low thesis seems to be a pretty good idea right now. That to me makes sense, But are we expecting a big like momentum breakout to the upside if the technology sector remains in range through here, if semiconductors are in range and sideways? No, I would dial back expectations about a momentum style breakout. The market does not have momentum right now. It's balanced, right? Let's take a look at real estate, lightweight sector, still possible for a lower high here. Financials, again, the poster child for the S&P over the last couple of weeks. This is the only thing that's really trending. And you could take a look at JP Morgan. We're premature. We'll get to the core list of companies in a moment. But, I mean, it speaks for itself, right? Mr. Demon thinks America's open for business and Mr. Diamond? Mr. Diamond thinks America's open for business, and the chart price reflects it. He's going to do all the business. He's going to do all the M&A. Okay, so JP Morgan driving those financials higher, this being the second heaviest weighted component of the S&P 500, it's again, probably more indicative of the base case being bullish. That's more so the correct viewpoint, in my opinion, with financials backing the S&P the way they are. Utilities, lightweight and sort of defensive for the broad market, but over a key level from this prior balance over here. To me, upward pressure is upward pressure, downward pressure is downward pressure. It's not outperforming tech. It's not outperforming semiconductors, so not a red flag yet. Communications, up near all-time highs. As noted earlier, this is the only other sector that's still printing new all-time highs. Everything else is off the highs. So helping the case, it's not in the top 4 heavyweights for the S&P 500, but certainly more of a risk-on indication than a risk-off one. If we take a look at the XLP consumer staples, this is actually kind of an interesting data point here where if we reject this and rotate to the downside, yes, downward pressure for the market, but what would it suggest on a relative performance basis if the broad market can just remain sideways in the range? Well, if consumer staples are not outperforming, then do market participants really have a defensive posture? The answer would be no. Like, this is your flight to safety. Oh my goodness, people can only afford to go out and buy the staples, right? That's why it's called the consumer staples. If this rejects here, people are just not interested in consumer staples. And as long as technology is still inside of its range, as long as the semiconductors are inside of its range, as long as financials are trending to the upside, it's not really a big deal to me. If everything else is moving to the downside and this rejects, right, that's your if and statement, then yeah, that's probably more like recession. Nobody can afford anything. But at least financials are performing well right now in the tech sector. Although, yes, it's annoying in its range, it's not like it's in an aggressive downtrend. It's really just sideways. Energy sector. Let's talk about this. This will be a great segue into inflation as well in just a moment. We'll talk about the CPI segment shortly, but look at what's going on here. Neutral in the midpoint of the range. This has come off somewhat aggressively. I think what I want to illustrate, and again, this ties into our inflation commentary in just a moment here. Let's go to crude oil. CL, can we get a load? Thank you, Thinkorswim. So notice the size of this box. This is the month of December. This is the month of January. Obviously, CPI that we're getting in February is reflective of the January inflation, right? We're going to see a downtick out of inflation from fuel, light sweet crude, technically crude oil. Not that it's deflating, right? But the size of the gain, if you take the beginning of the month to the close of the month, beginning of the month to the close of the month, is smaller out of crude than what we saw in December. If crude's not enough for you, we could do the same thing out of natural gas. Natural gas is down on the month of January, right? You can see here up through the month of December, down through the month of January. So that's going to be deflationary for energy. The crude oil is going to be disinflationary, not deflationary, but disinflationary. And if we take a look at RB, this is gasoline futures for anybody not familiar, this also is going to be disinflationary, not deflationary, disinflationary here. The size of the box smaller than the previous month's read. Now, I totally understand, right? You have this spike, and you can see the same thing out of CL as well. You have this spike where things got out of hand. But generally speaking, this, in my opinion, will allow the volatile energy component of inflation, we'll see this broken out in CPI, to downtick. So the headline number, in my opinion, should come in at the expectations right now, which are slightly below the previous month's read. I think we have something like a 0.2 forecast instead of the 0.3, 0.4 we were looking at for last month. So that's the talk about energy. That's the talk about inflation. We'll move back into our sectors and talk about industrials. Here is just kind of a neutral, maybe bull flag in the context of this daily breakout to the upside. It would have been ideal to hold up and over this, but only about 8% of the S&P. So we'll move along to, we'll talk TLT in just a moment. Let's finish the sectors first. XLB materials over the level. If it breaks back down, I would have slightly more concern here. And again, we've been tying this with the XHB home builders, which have been rolling over aggressively. So this is a concerning looking chart. And this probably sides a little bit more so with the bearish data points we've talked about so far. But the exercise of walking through all of these things here together today is to just say, financials are the only thing that's performing well. A lot of other things are in balance ranges. I mean, certainly don't get me wrong, the healthcare sector is up massively off of the lows, but it's still in a weekly downtrend. It's in a daily uptrend, so it would need to see sort of a higher low reversal here. If we get a clean higher low out of healthcare, I'll change my tune a little bit more so on it. So watching closely, 143.75, 147.50, we're in a balance range. It seems like the market can't really get further acceptance over this previous pivot high. We've stalled out after the Wednesday close above. So look above and fail on that could mean daily higher lows on tap, and if that takes place, we're probably looking at maybe some downward pressure for the S&P, right? That's that. Remember, it's the third heaviest weight sector by market cap, and then fourth is here. Sorry, actually, I think it's reversed now. I think the XLV is now the fourth, and the XLY is now the third after financials. You can see here, again, not breaking out to new record highs, so manage the expectation for the S&P 500. We're underneath what would have been the ideal right shoulder for inverted head and shoulders along these lines. It's still possible to catch a higher low, but you would need to stay over Monday's low of last week, which is probably the clean number at 225. We'll make it dim, not to get too level happy with these sector charts, but you get the idea. If we're over that on an open over 227.50 on Monday, I would definitely approach the market with more of the bullish stance. So, a lot of individual metrics to be talking about here and keeping tabs on. Generally, I think the totality of the data points we've seen so far, based on their weighting and relative importance to the S&P, would probably lean more so bullish to neutral stance, looking for the possibility of a daily uptrend to emerge in the S&P 500 on its own. All right, let's take a look at the ratio grid. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Sideways out of this, underneath a downward sloping now 50 SMA, kind of a concern. This rolling over, a little bit of a concerning look here. Financials are the poster child, they look fine, and healthcare, a little bit more neutral over there. Do we see a flight to safety risk off move though? This is a non-issue, and this is a non-issue over here. If we take a look at some specialized ratios, we will see that this is more so a volatile range than anything else. It is a bearish one, being underneath the 50 SMA, but it's flat and neutral. This is underneath an upward sloping 50 SMA. Not great. This is just hardly underneath a still very strong upward sloping 50 SMA. Again, not great. So these indications, a little bit of a mixed data point here. If we look at the ARK, innovation fund versus the S&P 500, I think that this would, tell an opposing story, which is that there is a relative appetite for risk out there in the market right now. Seeing that ARK is technically outperforming the S&P as it attempts to break out over this flat top high, regardless of what the sector relationships are doing up here. So not an end-all be-all, but that's maybe more so leans into the neutral side of things. If we look at the dollar and get a little bit fundamental here, the upper wick there certainly suggesting that it's possible that this pulls back a little bit. This is in an interesting relationship with gold right now. If we actually move to the gold chart first before interest rates, gold has been screaming to the upside. So there's a lot of talk about, what does gold know that we don't know? Is it possible that it's inflationary? I just think it's, generally speaking, and this seems to be the consensus view. I'm certainly not going to try to claim this as like an original thought or, hey, I beat everybody to the chase. It's just a flight to safety, right? It's a flight to safety in a world where the drop of a headline, the drop of a tweet has the possibility to shock the market. So gold is seen as sort of that hedge, the safe haven. That's sort of what this would suggest to me. The fact that it's outperforming the S&P here a little bit is a small concern, and again, probably ties back into okay, instead of being overly bullish, this would be a neutralizing data point, right? Let's take a look at interest rates, because as mentioned in the introduction, there's a pretty impressive break of the head and shoulders. So you have left, head, right. Here's your neckline, break of that, of course, on the Wednesday gap down. And notice that even with the initial sort of fears of inflation coming back into the market from the University of Michigan sentiment survey, I mean, where did we rally? It's just a backtest of 4.5 on the 10-year, which is your absolute key level walking forward. If you're under 4.5, there's really not a reason to start panicking. Oh my goodness, the market's going to crash, do this, that, the other thing. And this is a great segue back over to the TLT chart, which is what we were just talking about. We skipped it for the time being. The reason that I skipped it is to tie it more so with the TNX, is just because what are the odds that we find a higher low over in this case, it's the inversion of the head and shoulders, right? So there it is. What are the odds we find a higher low over the neckline, break the trend line, and do something like, see a move here into the origin of the breakdown at 92.15? That would align as well with a flight to safety style move, especially if the broad market underperforms during that time horizon. And if bonds are getting a bid, it probably means that interest rates are moving slightly lower. If bonds individually catch a bid, lack of a better term, use it again, then it'll pressure interest rates lower, but it'll be it's a different mechanism. Let's frame it that way. It's a different mechanism versus the Fed coming out and intervening with, hey guys, we're going to cut rates, right? That's the point I'm trying to get at. So please just understand that, right? So speaking of the Fed, we can go back over here and we could take a look at the inverted ZT, which is the 2-year interest rate basically, and notice that it saw a little bit of an uptick here. So the Fed tracker tool, by nature of seeing an uptick there, should be seeing an uptick out of the odds for a pause, which is absolutely the case. These were about 85% odds as of the Friday morning session. They've now moved to 92% odds, which, I don't see why it's so shocking that the market digests this. Whenever the odds are over 50% that something is likely to happen from the Fed tracker tool, I can count on one hand the number of times, less than one hand, give me 2 fingers, and I can tell you the number of times that the Fed has done something outside of what the futures market has priced in. So when we have those 50% odds, I understand it represents a shifting mindset, between the participants. But I mean, why? It's just, I'll leave that be. I will not go on a tangent about that, and instead I'll save you the time. The other interesting data that we got last week, of course, was around the labor market, which gives Jerome Powell some fire cover to basically say, hey, higher for longer is fine because the labor market's not breaking. The white line here is the unemployment rate. It is at 4% as of Friday. It is underneath the 12-month, aka 1-year, rolling average of unemployment, and the SOM rule has actually uninverted. It's been uninverted for about 4 months now, 4 cycles of unemployment data. This typically would signal a recession. It is not continuing to signal that a recession is looming based on the rate of change. It's the rate of change relative to the last 6-month high and low of the unemployment rate. So there's your SOM rule. The other information we got, which was interesting because it's inflation data, in my opinion, is the ISM services PMIs. You can see a downtick happening here and a downtick happening here. This is prices paid and new orders. So the fact that they're not divergent, notice that this blue is prices paid, is big time up where we go sideways here out of new orders. That's inflationary when they're divergent like this. The fact that they're down both in tandem is not necessarily deflationary, but it's not inflationary. We'll frame it that way, right? It would really depend on the rate of change, and it's just not so obvious, and I haven't done the math between the difference of the change between these, right? What is this versus what is this, and which one is more, right? So anyhow, that is services and what we had last week. This is also interesting, so please buckle up your seatbelt. This is just an interesting observation because it is the biggest spread we have seen basically in forever. This is relevant to the University of Michigan's inflation expectations by political party affiliation. Notice the spread between Republican and Democrat expectations. Republicans think that inflation is going to disappear and go to zero, whereas Democrats think that we are in a new wave of inflation. Buckle up, you're going to be bringing a wheelbarrow full of cash to go buy a loaf of bread. The spread is as large as we've ever seen it. And again, this is not a comment one way or another. It's more of just like, hey, what is going on here where the spread has widened this much and the independents are right on the money, right? So I think that tells you something a little, what this tells me is that the headlines will continue to drive market volatility. This is representative of market volatility. Massively divergent opinions across the aisle. This is, going to be the worst thing in the world for the market. This is the best thing in the world for the market. It doesn't matter where you fall. At the end of the day, for us as traders, it just means that volatility is here and it's not going anywhere if spreads are going to continue looking like this. So that's the comment there. As we take a look forward towards inflation expectations, we talked about how energy is likely going to put some downward pressure here. I think that it's very possible. You see the, where is the month over month? I just want to make sure I'm looking at the right one. I think it's very possible. You see the forecast move, which is the lighter of the two. This is the month over month non-core, so it will be inclusive of energy at a 0.2. The core, which is excluding the energy inflation, food inflation, the two volatile categories, is slated to come in at a 0.3. I think that's what we should watch out for. Noting what we just saw with crude oil, what we saw with gasoline futures, what we saw with the natural gas futures, I think this is spot on the money. I think this is where we'll learn a lot more, specifically around rent of shelter. Shelter inflation continues to be the sticky one. That's what we'll keep an eye on. Okay, that is what we have. There's going to be some testimony from Jerome Powell. It's the semi-annual monetary policy review. So Congress and the Senate and all that stuff will be peppering him with questions. If you've tuned in before, you know that it's 100% a clown show on all sides, and people will just use the opportunity to push their agendas and ask silly questions that I hope Jerome Powell has the backbone to say, like, that is not within my range of expertise, no comment, just like he did during the Q&A press conference from the FOMC last week, or what is it, 2 weeks ago now? It's crazy. I'm losing track of time. I think it was last week. Moving along. Earnings. What's going on with earnings? We have this. Market is rewarding positive EPS surprise less than average, and the reason for this, we've been talking about it in the pre-market preps, is because we have seen horrible forward guidance. Horrible forward guidance, and the market is punishing that. So there's a couple of interesting things that actually does, is it does set up the opportunity for a stronger beat. If I just quickly scroll down to the bottom end of the report here, what I want to get to is this. Quarter over quarter. So here's the expectation for Q1, what we're currently going through right now, which will be reported obviously in the future. There's the possibility to beat this. If we do see interest rates come down, if inflation is a non-issue, if the tariff talk and volatility ends up sort of like blowing past, and maybe there's not as much concern about foreign exchange on these guidance calls, because that's really what it's been, the strength of the US dollar, right? Maybe we can see a beat here over 61.23 for Q1 2025, which in theory would be bullish for a number of the stocks out there that have certainly gapped down on earnings. I'm thinking primarily about the tech cohort. So that is your calendar, or sorry, that's not the calendar, but that's the forecast from the report here. And I also think it was interesting at the very top. Sorry, I know that these scrolls are kind of crazy. You see a record number of companies, at least over the last couple of years, starting to talk about tariffs on the call. It's very reminiscent of 2018, Trump's first term, when he first started talking about tariffs on Chinese goods. So we're getting back into that realm. If you haven't been adapting to the Trump market, the Trump administration market, then it's certainly not an easy one to trade, right? Obviously, you have to stay very nimble, but those market internals should be helping us continue to watch the strength intraday. Let's take a look at the earnings calendar for this week. It's loaded. Mickey D's, the Golden Arches, before the open on Monday. Speaking of Monday, it's Monday.com. That's not something we're watching, but McDonald's, certainly it's interesting. They always have an interesting perspective about, quote, the American consumer, right? Lattice is interesting down here. That has to do with semiconductors, of course. As we continue along, Shopify is usually a decent trader around earnings. Coca-Cola, Warren Buffett's favorite. We can see BP on the energy side of things. We'll see if they have any comments about inflation on that. I would say Super Micro is not really a top watch, given all of the controversy around the stock here. Might just be a popcorn honorable mention, if you will. Gilead should not be forgotten down here from the healthcare perspective. I would say Vertiv as well. Healthcare there. Reddit will be interesting. AppLove and Robinhood, I'd say that those are your top three there. As we move along, TTD should not be forgotten. Cisco's a long lost, ancient relic, not worth watching. Datadog on Thursday, Coinbase. Twilio's chart is very, very impressive. And AMAT from a foundry perspective on semiconductors. Palo Alto, why did they not include that higher up the list? I certainly think it should be. Definitely over DraftKings. Incredible. Moderna here on Friday before the open, lower tier watch. But those are your honorable mentions this week. We're getting into, we're through a majority of the Magnificent Seven. Obviously, NVIDIA is the only outstanding one there. So that is what we have. Let's take a look back on over at the risk appetite charts for our market. Let's continue along with our analysis. As mentioned, the TLT, if it breaks the trend line, could go on a little bit of an outperformance here, which would be a flight to safety style move. We're not all the way there yet, but it's something to keep an eye on. As we take a look at bonds relative to themselves, this is actually confirming a little bit more of the thesis that I've outlined so far, which is that inflation expectations were almost unhinged on, or the response to inflation expectations were unhinged out of the market on Friday. If you look at bonds relative to themselves, I mean, the shorter end of the curve is not getting the love. It's not seen as being outperformative of the longer end of the curve here. So those expectations, again, a little market's response a little aggressive, seeing continued downtrends developing out of these bonds relative to themselves. Moving along to the credit spreads, volatility here, absolutely. So, not out of the woods, but definitely not along. Let's frame it this way. If you zoom out, charts have been moving from the upper left to the lower right. Upper left, lower right. Is it, oh my goodness, the market should crash? No. So more of a neutral, if not bullish data point, honestly, when you zoom out on those. If we look at HYG in isolation, it's sort of mirroring the market here with a lower high into the end of the week there. And if we take a look at LQD, though, this is where we have a divergence. It's a bullish divergence. Notice the higher high versus the lower high happening here out of the SPX. So interesting stuff, and probably neutralizes more of the data points. I hope you can see the totality of the data we've talked about so far today probably supports the bullish to neutral edge. Bitcoin as a risk-on asset still looks great, holding up in this flag consolidation. We do have the bearish signal out of the Sailor Shift tool. If you want that, it's available over on our site. Let's even drop it down to a daily time frame chart. Let's get granular here. So the tariffs on the Monday session certainly caused for concern right to the area of support that needed to hold, and what happened? It held. If Bitcoin breaks underneath 92,000, I would look to MSTR MicroStrategy, which is no longer micro, it's just strategy. I would look to that for a possible short. As an idea, it's underneath 360 as a balance range, right? What else? Breath. Let's take a look over here. Breath rolled over a little bit into the end of the week, This neutralizes the data points, right? It's not outright bearish. We did not have a negative print here. We are underneath the 50% mark by a hair on the 50 SMA blue moving average line. 200 is still above. So again, neutralizing data point there. As we look at the RSP, it is still over its key area of support, previous resistance, top end of the range, acted as perfect support via the gap down on Monday. I like that. So far, still bullish here out of breath. If we take a look out of the equal weight NASDAQ, we are also still above this key area from in the past, just as a relative measure, right? We wanted to make sure we stayed above, even though this drawdown was much deeper underneath. So all set on the equal weights. As we take a look at volatility, notice that we are at the 15 floor. It's tended to act as a floor. We'll see if it spikes here into the Monday session, depending on what fun and games we see over the weekend. Let's see what we have out of the VVIX. Same concept, looking like, maybe we found that floor. There's a new floor here at 95. And most importantly, let's move along to our volatility futures, which really light the way here. This has been nothing but helpful over the last little bit. So any inversions out of the volatility spread and posture? The answer is no. We do not have any inversions. We have not crossed through the zero mark. We still have back months, like way back months. Volatility pretty flat and stable here. Market seeing some short-term volatility, but nothing to be overly concerned about in the long term is sort of what this chart would represent without any of these, crossing underneath the next most dim level. With that, I think it's time to move along into our core list of companies, and then I have two trade ideas for you, which I will have to bring back up. They're not coming to mind off the top of the head, so I'll have to look back at another screen for that real quick. Anyways, NVIDIA, 129, right? It's time. It is time. 129 was the huge overhead supply. It still is huge overhead supply. We started to close inside of that area as of Friday, which I find very interesting, noting that the broad market was down on Friday. So is it possible that NVIDIA, maybe after seeing this look below and fail, is ready to continue on up to the full gap close towards that 141.75 area? It's possible. Now, I would just remind you on the hourly time frame chart, we have basically seen a wall-to-wall move from point A to point B. There has been no major daily pullback for a higher low in this range. So if you're buying this at the tippity top of the move, are you setting yourself up for the best risk-reward opportunity? Probably not. I would tend to think that if it does pull back and set an equal high, that's where we would go through on the second attempt in short proximity of time. If we just get a move that goes through the pullback above, now at least you can say risk reward along these lines. But just longing this here for the sake of longing it because, okay, we closed over 129, it seems like that might be a little bit malinformed, misinformed. I would prefer a slightly better risk-reward opportunity here. NVIDIA, honestly, has stolen my heart over the past week, so got to be careful not to revenge trade this, but the 129, 140, 175 gap close overhead is certainly in play for the coming week's worth of trade. Relative outperformance on Friday, it looks decent. Got to give credit where credit is due. Microsoft, what do we see over here? It's done nothing for a number of years. We've known that. I shouldn't say years, number of months. We're near the bottom end of the range. What looked like it was starting to act as support earlier on in the week, of course, was shattered. Hopes and dreams were shattered on Friday, and we have closed underneath 411.25. So on the hourly time frame chart, you can see the name of the game is quite simple. We're just looking for lower highs here, or I would even entertain lower highs here. If we can continue to see rejections off of 411.25, 414.50, I would be looking for short-term moves into 403.25 and reevaluating when and if the market approaches that. I'm not really interested in a look below and fail. That was what really should have happened right here. If this was going to play out, right, you had left, head, right. Obviously no love over the neckline on the Friday morning session. Let's move along to AAPL and see what's going on with the one stock to rule them all. This is back to being the heaviest weight component of the S&P 500. The lower high is in. The lower high is in underneath the earnings gap up day, which was a nasty bearish engulfing bar, and we're still underneath the weekly key level. Really don't have anything bullish to say about this chart. I would not be trying to fish for longs down here. To me, looks like an opportunity to say, okay, we have a beautiful H pattern, and we are looking for the possibility to break through the equal lows to set the move into 219.75. When we get towards this area, I would not be seeking new money shorts. The daily 200 SMA is not something to play around with. As we can see from in the past, this will be the first test in a very long time, right? First test, best test. Second test, if we reapproach, we're sort of still in the neighborhood of the possibility of a response from that via the buyers, right? So that's what we have out of Apple. Let's move along to Amazon. The overhead supply here is concerning. The fact that it was a perfect gap fill reversal on Friday is sort of a lot of these things almost happen too quickly to participate in on the consumer sentiment and inflation expectations move. So ideally, it's just this, right? Show me some sort of lower high here and we'll trade it to the downside. Unfortunately, Jeff has been very lucrative and very good to us through these past couple of days, but we might have to flip it up and trade some short side here if we can get risk reward along these lines underneath 230.250 into that 225.25 thin structure retracement from back over here. So firstly, seeking the lower high, something that looks like this, daily 50 SMA, changing tone when we get here. Is it possible for support? The answer is absolutely. Here it is on the daily. We'd be trying to support over this major low. Let's move along to Google. Earnings here causing some havoc, but just at the bottom end of the range. So the ideas here should probably be more so along the long side, saying, is it possible that we see a look below and fail? Is there an intraday higher low that can be found over 185.25 at the bottom end of the balance? If that's the case, on the hourly, it might look something along these lines, where it appears as, here, that's already that. Let's do another push, and then we have a double bottom, right? So there's your double bottom. Back into this range is probably what we're trading for, and then bulls, show me this, right? I was really more so interested on Friday in the possibility of opening inside of the 2-bar range, this Brigade bolt there, no dice. So we'll see if that is a back burner idea, if it will come into play over time, or if we drop from the overhead range, if this look above and fail, which is complete to the bottom end of the target, if that is complete and we are going to continue to see downside, it's all about the Willow gap, right? Remember the quantum computing gap from back over here. This probably represents in the higher time frames a better buying opportunity on that gap fill reversal area in the daily 200 SMA out of Apple. That's 176.35 on the chart. Let's move along to the metaverse. It's one of the stronger names out there. Amazon was as well prior to earnings, but now that's changed, of course. So Meta looks a little top heavy. It's been this way for the past few sessions. Notice the upper wicks that are developing on this daily chart. We're still printing higher lows and higher highs, and I think this is something like the 15th or 14th consecutive day in the upward direction. So it's still definitely bullish, but I would keep an open mind for a pullback at some point, or just further range consolidation is fine. Eventually, show me the Brigade bolt so we're not chasing this at the highest high with no reference for a potential stop loss, right? That's that. If it is going to reverse more firmly, I would really wait for this 682.25. If that breaks down, I would probably start, eyeballing the 635.25 from the daily perspective, right? Where's there some sort of pullback that looks like this for a higher low into the future, right? It's been a very impressive breakout post earnings, but where is this to really set up the next major long opportunity, right? Next up is Tesla. Tesla looks weak, breaking down underneath its balance lows. So no dice from Mr. Musk. A nice little rejection there on the 377 level into the Friday session. So caught between a rock and a hard place. It's been quite a wide range there. But the reason I say caught between a rock and a hard place is because of this previous breakout level in the past. We've been waiting very patiently for the full retest of 358.50. Yes, we've sort of lost some interest in Tesla through this box back here, but now that we're at the zone, I think it's time to continue to watch this on a day-by-day basis and say, okay, is it possible that we could spot some long opportunities here off of Tesla 358.50, the retest of the balance highs that we're broken out of, obviously. So thinking about that, if we do get that reversal, the first target would be the gap close. The way that you might look to play this could be some sort of inverted head and shoulders on the hourly that then breaks out over the neckline. That could be an entry point. Then, looking for generally risk reward, trying to traverse that range. It's an idea. If we start to fall back down underneath 358.50, yikes, a little bit more neutral through there, and the pullback buy opportunity, that ship has sailed. Let's move along to JP Morgan, which we've already covered. It's an absolute rocket ship. Thank you to Mr. Demon. And of course, we are hanging out here near the all-time highs. Really not much commentary. Higher low pullbacks persist over 270. And the same can be said about Netflix. Not much commentary here because it's doing what it should do. There it is. There it finally is. We have the earnings range breakout. So over 999, as long as this higher low can hold from the Friday low of day, we are set to jet out of Netflix. I'm pulling up on another screen here a couple of these trade ideas. I told you I had two, and I do have two. LLY, Eli Lilly, is the first one on the chopping block. Chart looks great as of the earnings breakout. Apologies for not doing my homework. It looks like I did not sit down to the desk before doing all my levels, but we have 848.50. If we could stay above that, looking for continuation in the upward direction, we have a huge balance range, which is broken out on earnings, inside consolidation on the Friday session. I think it actually made a slightly higher high. Yeah, slightly higher high, but nothing too concerning. I would be watching for retest entries, Brigade bolts, if you will, around 848.50. Can we get something that looks like this for continuation in the upward direction? Heck, if it gives you an intraday breakout of this, let's go down to the hourly for that. I'll give you the level here. That's going to be at 885, let's go 75. If we can Brigade bolt here intraday, you're probably looking for upside as well. And your target, the full gap close, that's definitely a scalp target. But beyond that, you'd be looking for this shelf up here, closer to 935.75. We'll go round numbers only on that one. And we'll go round numbers only on this one at 98. Let's go 98 there. So that is Eli Lilly. That is trade idea number one. In a picture perfect world, it's this, higher low, Brigade bolt for continuation over time, and the healthcare sector recovers. The next one is on UAL. We have United Airlines, and I did do my homework on this one step ahead. So this thin structure is really what I'm paying attention to. I like the consolidation back, near this level, the hold after the gap down on the Monday session, of course. So 110.50 is a very clean level. If we can get over that level, I think that we have nothing but a thin structure retracement into 116. So the reason I like the chart is just because the risk reward metrics are very, very clean and easy to identify. Right? If we can spot the correct setup, if there's an entry point that's given over 110.50, I think that it's, very clear what the target should be. So risk reward here makes sense in the upward direction. So two long trade ideas for you in completely different sectors. We have United Airlines and Eli Lilly to end out the video. Thanks so much for hanging out with me on this Saturday before the Super Bowl. I almost forgot that was even yesterday. I have no horse in the race. If you do, I'm sure we can stir up some of the people in the comments section, drop whoever your team is, and we'll see what the aggregate opinion is of the Trade Brigade, and we'll see what's going on with the penthouse and whether or not we need to have a post-game analysis on Monday. Anyways, enjoy the weekend. If you learned something new from the video today, if you enjoyed it, do me a favor, leave a simple thumbs up, leave a comment down below. We'll see you back here in the office on Monday morning, 8 o'clock Eastern time for our typical and scheduled episode of the Pre-Market Prep. Hope to see you there. And with that said, have a green trading week.